let's hop into buying a call option. Now, we know that if we buy a stock, we have a long position. And we know that if we buy an option, we have a long position in that option. And we know if the option, there's only two types, puts and calls. So if we pay some premium to where we own the contract, the call option, then we'd be in a long position. That's called a long call. And this is a crude risk graph. I like these symbols, though, because I think it helps start getting your mind working on, you don't need to figure this risk graph out today. But boy, we can sure see that the potential is going here if the price, goes up, and if the price goes down, well, we're not hurt too bad. So that's a lot different. So we're going to spend a little time on this, and long calls, it just involves paying a premium to have a bullish upside potential on the stock. It can go up, but it's got a limited downside potential. And in terms of dollar terms, it's less risk than owning a stock, but in terms of time decay, boy, it can really hurt you. So we'll talk about that when we get to the aggressiveness meter. But our objectives are certainly a bullish outlook. So again, how many pillars are there? 4. Fundamental analysis should be bullish. Technical analysis should be very bullish. This is going to take a lot less money to get involved than it does to get in stocks, as we'll see, and as you can probably gather. And if the stock falls, we have very, very limited risk when the stock falls. Absolutely a limit on it. However, we'll talk about dollars versus percentages. This is going to allow for unlimited upside potential. If this thing goes to the moon, we're going to enjoy it. But why would I put very aggressive on the aggressiveness meter? Why not have it in here? Well, I'll tell you why. Let's say that we could own stock, and let's say that we can own a call option. And let's say the stock is $100 a share, and that the call is maybe $5 a share. So 100 shares of stock is going to be $10,000 at risk. Now, if the stock goes bankrupt, we're going to lose. The total risk is $10,000. That is the total risk in this trade. So when you trade stock, total risk $10,000. You buy 100 shares at $100. It goes bankrupt. You're out 10 grand. It's that simple. Well, we said that max risk for an option that you buy, a long option, equals the premium that you pay. Again, very different than the premium you receive as a seller, right? Very, very different. But as a buyer, the max risk is the premium that you pay. Well, let's say this is 500 and we do 100 shares. So that'd be $500, and that would be our risk. So that's the most we can risk. Well, someone's going to say, wait. You control 100 shares here by buying it, and you control 100 shares here as if you bought it, because you could buy it anytime you want. But because you haven't bought it, you could walk away, and the most you'd be out is $5 instead of 100. So, this is far less risk than this. Far less risk. How in the world can you make this aggressiveness meter say this is way, way risky? Well, I'll tell you why. 2 words. Time decay. You see, this has a long, long time to go up if we like it, and this has a long, long time to go down if we hold it. But this might have 3 months to it, right? This might be 3 months. Remember that milk? If you buy milk and it goes past the expiration date, what's that milk worth? 0. So if this stock doesn't go up and it doesn't do the things we want it to do, and we hang on to that option till expiration, well, that $500 would be toast in 3 months. So you could lose 100, and let's say the stock, we have the right to buy it at 100. Let's say our strike is $100. Well, if that stock is $99.99 on expiration, right, then we lose. It's of no value, right? Why would you pay 100 if it's 99 or less in the market? And so if it's just 1 penny down, from its strike price at expiration, this whole $500 is gone. So it's probably easier to lose 100% of $5 than it is 100% of 10,000. It's probably more likely that that would be 1 penny below the strike price of 100 than this going bankrupt. So yeah, in truth, we're risking far more money here, but the likelihood of it going to zero is very, very small. Here, it's guaranteed going to zero in 3 months. And so that's why this time element makes this much, much more aggressive. Hey, I've got to get this thing. I got to get my ice cream made before the milk expires. If I don't get my ice cream made before the milk expires, all the money I spent on that milk is down the drain, That's why we want to always have, plenty of time here to be able to do that. Always want to have plenty of time. So let's go through our long call where this person, very, very important, he's going to have a choice. So let's say this. This person has or wants to purchase, has the choice. He's the buyer, remember, of this option. And this person makes a promise. So you can see we can be on either side. We can be the person that makes the promise and gets paid, or the person who has the choice and pays. Remember, this is called a what? A premium. It's called a premium. And this person has the choice to buy, we'll put that in big letters, to buy 100 shares of stock at a strike price, at some set price, whatever it is. Let's just say, buy at $30 a share, whatever it might be. And this person really makes a promise to what? To sell it, right? To sell 100 shares. We'll write it out, 100 shares of stock at a set price. And there'll be an expiration date. Maybe it's 3 months away. Maybe it's 5 months away. But that's the agreement. I'm going to pay this guy some money so that he'll do this. And that's going to give me an option. And so the stock could go up or, it could go down from there. So let's just say that the stock was at $50 and we were going to do an at the money option. And so, I'm going to buy the stock at $50. Well, this is interesting. That way, if the stock goes to 60, that's pretty exciting. And let's say the premium for this was maybe $2.50. Well, now his max risk isn't $50. The max risk of buying stock at this price, we'll just say buy, the max risk of buying stock, if he buys 100 shares, would be $5,000, right? That'd be the max risk, but because it could go bankrupt. But the max risk of buying, we'll just write it out, buying a call right here, well, that's $2.50 times 100. That's only $250, right? Well, let's say that this is 1, 2, 3 months long. So this expires in 3 months, right? So he's going to do this at $50 a share, but it expires in 3 months. That could be rough, because if the stock goes up, let's do the first time. If the stock goes up to say 60, we're going to be pretty excited, because we're going to have what? $10 of intrinsic value. Well, God, you only paid $2 for it. $10 times 100 shares, that's $1,000 on a $250 investment. That'd be awesome. Well, let's say that the stock goes down though. Okay. If it goes down and it's 1 penny below 50, this 250 is going to go away. It's not going to be worth it, because why would we want to pay $50 for a stock that's down here at 40? We'd be very, very sad if that happened. But think about that. If you had 100 shares of the stock and it fell, $10, you're going to lose $1,000. Here, the most you'd lose is $250. So we're going to talk a lot about, what would happen if it went up, what would happen if it went down, and we're going to spend a lot of time in our risk graph stuff here. Let's pull this out. And we're going to have a lot of fun with this. Now, let's say there was a stock. This might be fun. Let's say, let's just use Apple for an example. Okay, so Apple is of this recording right here. Let's bring this up, see if we can get a little data here. It's like wanting to wait for our data. It's going a little slow for us here. Symbol right, that helps. So this is like a $250 stock, man. $250. What do you think? Money grows on trees? My gosh, $250. Holy cow. So maybe someone doesn't have $250, right? Well, they could come in here and take a look at an option chain, right? Let's blow up our option chain nice and big, and maybe we go out. We want to go out a little bit here. You know, we got November here, December, January, February. I kind of like that 3-month area, you know, 3 or 4. And we say, look, we got our calls on this side, and instead of spending $260 for it, we say, look, let's buy a call at $260. Check this out. The strike is $260. We have till February to do this. You know, let's see, November, December, January, February. So 3-4 months out. And you'll notice that the mark on this is about $13.11. So $13.12 to be exact if we round up. So think about that. If you buy Apple, it's going to cost you $260 at risk, right? This is the risk if you buy the stock, right? This is the risk if you buy the option. But you got to hope that this goes up at least $13.12 before we start making a profit. Let's do a couple more. Let's just throw out, what would another one be that's got a little price to it? Like maybe Amazon's got a little bit of price to it right here. So Amazon's sitting here at, $1,700 a share. And, you know, if you buy 1,000 shares, you know, that's 1.7 million. Is that correct? Is my math correct right there? So let's just double check that math. But as far as I'm concerned, you buy 1,000 shares of Amazon at, we'll just call it 1,800. We'll just round it up there at 1,800. You know, you're looking at 1.8 million for that. If you want 100 shares of Amazon, just 100 shares, you times that by $1,800, and you're still looking at $180,000. So someone might say, well, you know, I want to participate. I want to be able to do this, but I don't have $180,000, you know, shoved down my mattress right now. I don't have that. How can I leverage this without borrowing? You know, if this were a house and it was a $180,000 house and you had to come up with 25% down to buy that as a rental property, you're still looking at $45,000 you got to raise. So if you're good at raising money, raise the equity, let them do the debt, and you've got a house. But they don't do that with stocks necessarily, but I'll tell you how you can leverage it. You can leverage it with an option. So let's go out that same 3 months, and let's go to that 1780 where it's at. 1780, look, $100, right? $100. And so now for $10,000, right? 100 times 1,000. Now for $10,000, you can control, what is that, 1780? So 1780, but remember, we're doing 100 shares. You're controlling $178,000 worth of stock for, you know, very small, and it's not really a down payment because you're not getting any equity out of that. It's only time. But think about that. You know, that's not bad. 10,000 divided by 178,000, you know, you're 5% down, you know, 5% of that, you can control that stock, and that's fun stuff. Now let's go further with this. Do we have anything on Amazon? Let's hope not. Okay, we don't, so this is good. So let's do this. Let's, you know what, let's, is there a way to duplicate this screen? I don't know if there is. I'm going to try to. Yeah, let's see if we can do this. Fine, let's clean this up a little bit so we're not all over the place. So let's watch this. Let's buy this. Let's split the split it here, and let's do it at 97. That'd be kind of good. 94. That looks like a good good mark right there. So let's go 94. So let's say we buy the stock for what they're asking. And let's look at what that risk graph looks like. So here is what that risk graph looks like. And you can see that as it goes up, you're making 10,000, 20,000, 30,000. But as it goes down, you're losing 10,000, 20,000, 30,000, right? So that's on that side of things. Let's go that up, build that nice and big. And on this side, no, I'm getting kind of busy. This is why people have all these fancy multiple monitors when they trade, but you don't need it. You can layer it up like this. But on this side, we're going to go to December 20th. And let's go beyond that. Let's go out like we said. Let's go out to February 21st, like we said. You want to buy plenty of time because of that time decay factor. Let's go 1780. And looks like we can get 94.43. So we're going to make that 94.443. So let's change that to $94.43 because that's what we can get it for if we shave the spread right out here. So that's good stuff. Now let's do a risk graph of this and a risk graph of this. And this is what is fun to do for people, is to put them side by side like this. See, put them right there side by side, and maybe even them up a little bit to where they look, sort of similar. And you're going to notice something that the most we can lose in this is this $10,000 right here. See how that line at the bottom ends? Why? Well, if it's 1 penny under the strike price, right? 1 penny under that 1780. My gosh, then it expires. You can see that that's how much we'd lose. But here, check this out. Let's go, this looks like this goes up to what, 2050? Look, here you've got your 5,000, 10,000, 20,000, not quite your 30 because it's costing you 10, but you'll notice that the slope of this line is as if you owned the stock on the upside. It can go forever, but instead of having this downside, it goes there. Watch this. Let's bring in some more price and move this around a little bit if I can. And let's just really take this down to zero. See, here you'd lose $170,000 if it went to zero, if it went bankrupt, but you'd make a ton here. Let's do the same thing here. Let's bring this out. Well, here you can see that if the stock price doubled, you'd make this $200,000. And here, if the stock price doubled, you make this $200,000, right? It'd be really nice if it doubled. But watch this. If it went down, notice how the most you can lose is that $10,000 here. Why? Because we don't have to buy the stock. This is an option. We don't have to buy it. We can buy it at 1,700, and so if it goes up, we get all the benefits. No matter how high the price goes, we can buy it at 1,700 and get all these benefits. So it's like owning the stock with the upside without having the entire downside. So people look at this and they say, well, why wouldn't you do that every time? Well, Amazon's probably not going to double in 3 months, right? And it could go down, and it's probably easier to lose this 10,000, lose all your investment, perhaps than it is to lose all your investment here. So cool stuff. And the other thing is, if this does fall down and you're down 10,000 in this stock, well, you're still in the stock and it has a chance to recover. Over here, if it expires, you have no chance to recover. So please understand that while these graphs look very enticing, and you can get into big stocks with a lot less money, word of the wise, be careful. Let's look at our KHC, which is a cheaper stock, and let's do both here. Let's do one where we're going to buy the stock, so we have our risk graph like we normally would here, right? Just a regular old stock type of risk graph. And let's add a simulated trade. Let's go out to February with KHC, and let's just go let's go buy one here now. 205, 190. What's going to be our mark on that? Well, what's the difference between 205, 190? Well, it'd be, let's see, 195, 197, I'd say, something like that. So let's buy it. but we're going to get this for 197. Well, let's call it 195 maybe. Yeah, that'd be a fair spread, maybe 2, somewhere in there. And you look at this risk profile, and again, notice that here the most we can lose is that premium pay, that $1.95 times 100 is what? Well, about $200 right there. You know, about one looks like 195 is as much as we can lose on that, 195. Where over here we can lose a lot more. So this is kind of cool because this is a less expensive stock. And so, you know, over here you can see that we're risking much more money, right? If we buy this at $32.85, we bought 100 shares, that'd be $3,285 if you want to buy 100 shares of stock. But you know what? If you want to get a call option, it's going to cost you $195 to control 100 shares of stock. So this can be exciting stuff. It can be fun stuff. And part of the assignment I'm going to give you is to just do this with several different stocks. You know, look at these risk graphs. Get familiar with some of these risk graphs in your simulated trading account and just practice them. You know, if this is a little intimidating for you, we'll get in the coaching program and get someone that can walk you through and answer questions, and you can meet with every couple of weeks and make sure you're moving along properly. Okay, so this will be fun right here. Let's do one called Caterpillar. In fact, let's bring up Caterpillar's chart. And here we have Caterpillar's chart. And I'm going to show you something that's really interesting is, you know, you look at how far things drop, that can also give you a clue to how far they can rise. And you're going to notice here on October 11th, we had a big gap up right here. And we said, gee, you know, that's a big gap up. Maybe it runs. It might fill its gap and change their mind, or it might run. But it doesn't look like this one's going to stay the same, does it, based on its technical analysis. You know, the fundamental analysis on Caterpillar is interesting because it has a huge international footprint, right? They sell a lot of stuff all around the world. They're not a local business. So we thought, you know what? We generally like cash flow. We generally don't like to speculate much, but we thought, you know, boy, if this runs, instead of spending the $125 it takes to buy this, maybe it goes a run. So we'll buy a little shorter term option here. You know, take that risk on that time decay, and maybe it explodes in value. Well, it looks like it did, didn't it? It really took off for us. So this was a nice one. But here's something that's fun to see, is the first thing we did is we purchased this thing for almost nothing. So let's move this around a little bit so we can look at how little risk, if I can do this right, how little tiny bit of risk. It wants to keep going back to its default setting. But can you see that we paid 23 cents for these? So instead of spending all kinds of money, we bought the 145s, pretty interesting stuff here, for 23 cents. Now, this is kind of fun because, this just explodes in value as it took off to where we are today. So check this out. This is kind of interesting stuff. If we look at the trade, we did this on October 11th, and we got this for 23 cents instead of this, a 145 strike. So this is not at the money. This is way out of the money. This is kind of a crapshoot, kind of a luck thing we're trying to do. But we said, you know, we're not spending very much. We're going to spend at less than 25 cents, and, you know, times one contract is only $25, and times 5 contracts is only $125. So we just didn't have that much to risk there. About $125, from 0 to 1,000. So we thought, let's throw $100 at this, because the upside, if it keeps going, is massive, and the downside's not very much. Well, what was really interesting is as this went up, the options that you could sell were pretty good. And you'll notice here we did a transaction later on the 5th of November. So that's about 5 days ago from this recording, on the 5th of November. And we were able to get $152.50. Well, look at that. That's what, $7.50 difference. So look at this. we have the right to buy it now at 145, but we've promised to sell it at 152. Well, would you be okay in buying something at 145 and then promising to sell at 152? Guess how much they'll pay us for that promise. So it's almost like that covered call now, isn't it? Is we're covered now because we have the chance to buy at 145. We can now make the promise to sell at 152. Guess how much they paid us? 39 cents. Well, wait. We paid out 23 cents to own this option. Now we're getting paid 39 cents to sell it. Wait a minute. If you bring in 23 if you only put out 23 and you bring in 39, that means you're actually making money, right? But here's the crazy thing. So watch this. This is so much fun. So look at this. $39 brought in, right? Minus 23 cents or $23 gone out per contract. That's 16. We did this on 5 contracts. So we're going to make about $80 on this just in premiums. But this is what's crazy. Watch. I'll activate that now. Look what that did to our cost basis. You see that? Since we did 4 of these, okay, since we didn't do, we still left our upside because we only did 4 of these, and that paid for our option. Okay, isn't that ridiculous? So look what we did here. This is called a ratio spread, where we spend 23 cents times 500 contracts. Why? Well, look, it's 5 contracts, 100 shares a contract. So watch this. 23 cents times 500 shares is $115, it looks like, is what that cost us. So not quite $125, $115. Now that's money going out to buy that option, right? To buy that option. Now watch this. So now we're bringing in 39 cents on this one, and we're only doing 400 shares, 4 options. So let's times that by 400 shares, and that brings $156, right? So if we bring in 156, right, and we only spent minus 115, that means that we have $41 that we made total, 41. Well, sure enough, you look at this right here. See that 41 right there? That's how much money we're guaranteed to make no matter how far down this goes. Wait a minute. Do you see what just happened right there? We just went risk-free. No matter what happens now, we didn't start risk-free, but no matter what happens now, we've already brought back more than we've spent. And what's the maximum risk? Premium you paid. So our net premium is plus $41. That means that no matter what happens, we'll make at least $41. But here's what's neat. Because we still have one open-ended option, this has infinite opportunity for return. And if you happen to look right here where we are today, we're up about $2,000 in this trade. So once in a while you get lucky. You know, I wouldn't expect that to happen every time, but that's the power of the options, right? Where you spend $150 or whatever it was, $115, and next thing you know, you're up $2,000. So that's a gem of a trade, and sometimes you do that. Now we prefer cash flow, right? This is hard to do. It's hard to predict that this is going to go nuts. And, I'll tell you, if it would have gone above that 145 mark, we wouldn't have anything to say about it. But this can continue to get higher and higher and higher and higher and higher and higher to the strike price. And then it's still, since we still have one option open, it can go higher and higher to infinity. So we're in a pretty good spot right here. This is going to expire in about a week. And so we'll probably let it run for a little bit, see if it runs. It's certainly broken through see how it came up and stopped at resistance right here. And so if it breaks through and continues to run, I'll tell you what, this could be a really, really nice looking trade. Now, this is where things are fun and come together. I always promote my Ultimate Options class because that's what business owners do. They promote their stuff. If your stuff's valuable, promote it. Don't be apologetic about it. And what's really cool is once you start learning how to combine these options together, gives you the opportunity for trades like this. Now, we don't make claims. You could have just easily lost this 23 cents per share times 100 shares, right? You could have lost 115 bucks. But when you hit a couple of these, it's kind of nice, right? It's kind of nice. And it can justify learning about these types of adjustments. And this is what you'd call a ratio spread. You know, it's a ratio of 5 to 4. And this is certainly a nice little spread right here. And the other thing that's nice is this is a Mentor Club trade. So if you're in the Mentor Club, you probably remember this one if you've been a long-time member, right? You say, oh, I remember when they did that. You know, I went through my options or my 4 Pillars course, the updated course, and yeah, I remember that one. So this is a nice 1-2 punch of being in Mentor Club every week and learning about these options. So that is the call option and some way cool things that you can do with these to make some money. Now, I probably took you a little further than I should have, you know, but it's fun to see what can be done. Just remember that, let's pull these off, that's what the graph looks like. You have limited risk and huge upside potential with these types of options. You know, a more realistic, this was a chance to, you know, it popped and we say, hey, if this runs, we'll make a lot of money. You know, if it doesn't, we'll lose a little bit of money. You know, more realistic, let's look at a different stock. Let's just go with IBM. You know, how might this be? Oh, we've got a trade on IBM. That's not going to work. Let's go with, oh, gee, we got a trade on Apple. Do we have anything on Verizon? Nope. So Verizon will be clean for us. So, you know, if I were to buy one on Verizon and I says, look, I think they might break through. I don't know. It's got a little bit of a double top here, so I don't know if I like it. But let's say it broke through and I was bullish on it. How might I do this normally? Well, I like the long-term option. If we don't think it's going to run quick in a short amount of time, let's pay a little more money for these. Let's go out to January, a few months out here. Let's spread this out so we can see our option chain. Well, this is going to let me drag it here. Let me pull it off my other screen. Might let me drag it a little better than the screen we write on. And I can see that these calls, you know, I might even go in the money a little bit because look, $55 for $4. You know, I can get it for 55. It's already trading at 59. You know, that's going to give me a nice fat 80-cent delta that you can learn about. And off we go. You know, if I go out of the money, I can get it for 7 cents. But is IBM really going to make it to $65 in that time? You know, probably not. So I'll spend a little money here. And I might go at the money or 1 or 2 strikes in the money, pay a little bit more because that means I'm going to get, you know, it's going to behave more like the stock. You know, come out here, it's more like a lottery trade. So fun stuff. You know, fun stuff. Let's just buy this one at 269 and look at what the risk profile is. Again, limited risk, 269. Let's just bump it to 270 for math. You can see the most I can ever lose in this is $270, no matter how far down it goes. But if it starts to go up, it's huge. And you'll notice that my strike price is at 57.50 right here, right in the middle, 57.50. Well, you'll notice that I'm underwater at expiration, that this has to move at least $2.70 before I break even. Remember, I have to have the stock go up at least $2.70 before I break even. You know, I didn't ever put in any risk graphs. You know, in my previous versions of the 4 Pillars, I felt they were too advanced, and I thought I had to balance it between, you know, do I want to take them too fast? But I just felt really good about being able to say, okay, what's my max risk? What's my max potential? You know, how much am I willing to risk? And you know, what am I able to possibly make? So if you combine these ideas with Mentor Club, it's going to help you a lot. I'll just express what this line is here. This is a good time to teach this purple line. Remember that this is an expiration where there's no time value left. If this starts to fall and I say, oh, I don't like where it's going, I can sell it before the time runs out, and I'll actually get this price for it right here, this price. So you see here, I wouldn't lose, $200. I'd lose about $70, about $74 right there. So that's nice. If I take the calendar and I begin to march it forward, watch how this time decays on me. Watch it fall. Ready? We'll just march the calendar forward. See how it's marching forward, and slowly my break-even point's getting harder to hit, and it melts down and it melts down. You can see it melt down. And finally, when I get to that January 17th date, here it comes, 16th, 17th, boom. Now it's expired and there's no more time decay or time value left in there. So this line represents my time decay. Here I have my expiration day. And you'll learn more about these. Almost everyone that does the 4 Pillars course also gets in the Mentor Club. And it's such a great one to punch, to see this done every single week. But here we have a chance to slow down and talk about what an option is. So with that, we have one more to do before we send you off to do some homework. When we come back, we're going to buy a put option, and then we'll do a summary, and that will be your completion of the 3rd pillar of investing, which is cash flow.